7:46, 14 moving up to 8 in this segment. Our friends from the Unit Trust Corporation are joining us. Our guests are Crystal Rodriguez-Greaves, who is the Assistant Vice President, Risk Management, and also Kerron Blandin, Risk Management. Today we're talking about investment once again and what's best for you in your particular situation. Good morning. Thank you for joining us this morning.
Good morning.
Let me start with Crystal on this. Crystal, I know we've been saying it over and over, but it's something that is kind of nebulous to many people. What's the difference between savings and investment?
Sure. Well, good morning, Paul, and thank you for having us.
You're welcome.
And a special good morning to all the unit holders of the Trinidad and Tobago Unit Trust Corporation. To answer your question, the difference between savings and investments, unfortunately, some people use the two terms interchangeably. They always think that savings and investments is the same thing. But there are a number of differences between the two. So, for instance, savings, that's where you set aside money for very short-term goals or for emergency purposes. So we normally recommend that you set aside at least 6 months of living expenses and you have that in a safe account. So in the event of any unforeseen circumstance, such as a medical illness or you may lose your job, you'll be able to tap into that savings and not have to use that or tap into your investment account. Right?
So that's easy, instant access.
Correct. So you want to make sure that that's in a safe place. So people tend to use bank accounts for that purpose, and because of the low risk associated with that, they would tend to be very low returns on that type of account. Investments, on the other hand, is where you put aside money with the objective of earning a return over time. So you're actually putting your money at risk for it to grow. So what you will normally tend to see with investments, that your money will fluctuate over time. So sometimes you would see increases, sometimes you would see decreases. So investments is where you put it in products such as stocks, bonds, mutual funds, with the objective that over time your money will grow.
Kerron, let's bring you to the conversation. How will I know how to balance my savings versus my investment? What process should I use to determine that?
Well, what we do is we look at something that we call risk tolerance. That refers to your ability and your comfort in taking risks. So Crystal mentioned that there are certain declines, the fluctuations in the market. It's your ability and comfort to take that on. So that there are two aspects to it really. It's about your ability and willingness, and there's a financial aspect to it and an emotional aspect to it. So that in terms of the financial side of things, you'll be looking at things like your net worth, which is your assets minus your liabilities. How much you'll be able to, how much of a fluctuation you'll be able to withstand in terms of the amount of capital that you have available for investment. You also have things like a time horizon. Time horizon is the time between the current time and when you'll need the money. So that's based on your goals, of course.
And your age.
Well, yes, any age. You're saying, okay, I want to invest or save for Carnival next year. That's a few months away. So that's your time horizon, a short time horizon. Whereas you may be thinking of saving or investing for retirement, that may be 20, 30, 40 years away. So that's a very long time away. You also have age, as you mentioned, which is related to your time horizon, because generally people who are younger have a much better ability to take on those fluctuations because they have a longer time to recover. Of course, there's the emotional aspect of it as well, where some people's personalities, they just don't want to take on risk. And there are other things, including your knowledge about investment products, those things. Some people have low risk tolerances, but they understand that while there may be fluctuations in the short term, in the long term, they may be better off taking on a lot of risk.
Crystal, and this is going to be a crash course for us. Give us some definitions about what are stocks, what are bonds, what are commodities, so that when we come to you, and I know you will go into more detail when you do one-on-ones with your clients, the viewers have a sense of, how to lay their basket, as it were, in terms of diversity.
Sure, okay, so generally we look at investments in terms of the different risk profiles that they have. So for those persons with lower risk tolerance levels, we recommend that they invest in safer securities such as fixed income instruments. So those will be things like government bonds, treasury bills, money market mutual funds. And those types of investments, generally the fluctuations in the value of those tend to be minimal, and you will earn an interest payment over time. So if you have a low risk tolerance, you would tend to have most of your portfolio invested in those types of products. If you have a high risk tolerance level, you'll be able to take on the risk of stocks or equities, right? And that means that you invest in the stock market with the objective that over time the price of the securities would increase. So for instance, if you have a high risk tolerance level, and let's say you invested in the U.S. equity market, over the 10-year period, 2005 to 2014, that stock market actually grew 70%. So if you had invested $10,000, it would have been worth $17,000 at the end of the 10-year period. But it wouldn't have been a straight line to get there. In 2008, when the market crashed, you would have lost 38% of your value. So you have to have that willingness and ability to accept losses in the short term with the objective that over time you would earn a return on your investment.
That's a great segue to my next question for Kerron. How do I know when not to panic and not to sell?
Well, it's important that you look at your long-term goals and you look at the long-term picture, so that while there be fluctuations in the short term, you understand that, as I said before, over the long term, if you take on that risk, you will benefit.
Finally, Crystal, what should persons wanting to come for a consultation come to you with, armed with, so that they get the best out of the consultation with the professionals at the Unit Trust Corporation?
Okay, well, when coming to us for any type of consultation, we always want to know what are your goals. So try to think about what are your goals over the next 0 to 5 years, your goals over the long term 5 to 10, and 10 to 30 years. So we will have an idea of what type of investments are best for you.
What are your commitments?
Correct.
Yes.
We also want to know like what is the state of your finances, how much debt you have, how much assets you have. So we need to know.
And be honest. This is the time to be honest.
Yes.
Don't hold back anything. It's good. It can have a deleterious effect on how the plan comes together.
Correct. So make sure and bring that information to us, and we're always willing to provide advice. So comment to us or call us at any time.
All right, the number 624 units,
Yes.
or ttutc.com. All right, thank you very much, Crystal Rodriguez-Greaves and Kerron Blandin. We'll take a short break and come back with our final segment. Stay with us.